Hello friends, in just a few minutes, you will learn about the most important financial terms. I guarantee it will be useful. Assets. Let's start with assets. These are things that have value and can generate income. For example, if you own a car, a house, or even have money in a bank account, those are assets. They can either increase in value over time or directly bring you money. You buy a stock in a company. That stock is your asset because it might grow in value, or you might earn money from dividends. Liabilities. On the flip side, liabilities are what take money out of your pocket. This includes debts, loans, or any other obligations you owe. If you take out a loan to buy a car, that debt is your liability. Until you repay it, you owe the bank. Capital. Capital is the resources you have that can generate more income. This can be money or other assets. You save money to invest in a business or stocks. That's your capital. Investments. This is the process of putting money into something with the hope it will grow over time. This can be stocks, bonds, real estate, or even your own business. You buy a rental property and earn rent every month. That's an investment because it brings you income. Stocks. Stocks are a piece of a company. When you buy stocks, you become part owner of that company. If the company makes money, so can you. You buy Apple stock. If the company does well, the stock price goes up, and you can sell it for more. Bonds. Bonds are like lending money to a government or company, and they promise to pay you back with interest after a certain period. Dividends. These are part of a company's profit that it pays to its shareholders. If you own shares in a company and it earns a profit, you may get a share of it. You own shares in Coca-Cola, and the company decides to pay out some of its profits as dividends. You get a slice of the pie. Inflation. Inflation is the process where the prices of goods and services rise over time. Because of inflation, money loses its purchasing power. A year ago, you could buy a loaf of bread for $2, but today it costs $2.50. That's inflation. Deflation. Deflation is the opposite, where prices fall and money becomes worth more. While that might sound good, deflation can lead to reduced economic activity. If everyone stops spending money and starts saving instead, prices might fall. That's deflation. Liquidity. Liquidity shows how easily you can turn an asset into cash. For example, money in your bank account has high liquidity because it's easy to spend. You want to sell your house. It might take time, so it's less liquid compared to cash in your account. Investment portfolio. This is a collection of your investments, stocks, bonds, real estate, etc. By building a portfolio, you try to balance risks and returns. You decide to invest some money in stocks and some in bonds to reduce risk. This is your investment portfolio. Risk. This is the chance that you might lose part or all of your investment. Every investment has its own level of risk. The higher the risk, the higher the potential return, but also the higher the chance of losing money. Investing in a startup could be very profitable, but the risk of failure is also high. Diversification. Diversification is a strategy of spreading your money across different assets to reduce risk. If one asset loses value, others might remain stable. You decide to invest not only in stocks, but also in bonds and real estate, so that if the stock market crashes, you have other stable investments. Credit. Credit is money you borrow from a bank or other financial institution that you're obligated to repay with interest. Credit can help you buy big items, but you need to be careful not to accumulate debt. Deposit. A deposit is money you place in a bank account that earns interest. It's a way to safely store and grow your savings. You put your savings in a deposit account at the bank. Every month, the bank pays you interest, and your money grows. Bankruptcy. Bankruptcy is a situation where a person or company cannot meet their financial obligations and declares they're unable to pay their debts. It's a last resort when there's no other way to repay what's owed. Margin. Margin is the difference between the selling price of a product or service and its cost. It shows how much a company makes from each unit sold. You produce and sell t-shirts. The cost to make one t-shirt is $10 and you sell it for $20. The $10 difference is your margin. Hedging. Hedging is a strategy to reduce risk when investing. It's like insurance. You use certain tools to protect yourself from possible financial losses. If you invest in foreign currency, you can buy a hedge contract that will compensate for your losses if that currency's value drops. That's how quickly we analyze finances. If you want more videos like this, click like and write what topic you are interested in next.